Welcome back after the break. So we'll be starting with the new topic, that is IND AS 36, which talks about impairment of assets. Impairment of assets. I think we have got one jalak of impairment. Once we have done impairment, I think where we did impairment, sir? We did calculate impairment loss in one of the topics. Can you help me recollect my memory? Where did we do this? When we did IND AS 38, intangible assets, we saw this impairment concept coming in. I just told you when impairment loss will come. Impairment loss will only come if what, sir? What is that? If carrying amount of the asset, if it is greater than recoverable amount, then only you book something known as impairment loss. That's what we have been doing. Yes, no? Okay, now we're going to be studying more about the impairment loss, when it will come, when you need to recognize, how you need to recognize, etc, etc. A lot more detailed we'll be studying this concept of impairment loss in this particular standard. But this we have already applied. I think everyone is comfortable with this. Yes, no? Okay, great. So let's go ahead and learn this standard. One is the scope of the standard. It shall be this impairment standard will be applicable for all assets except a few of them. One, inventory. This impairment, whatever you're doing, don't apply it to inventory because AS2 gives you a comprehensive treatment for it. AS2, IND AS2, AS2 and IND AS2 same names and the same naming conventions, similar naming conventions. Okay. IND AS2 says inventory should be valued at cost or NRV, whichever is lower, right? So that standard takes care of it, so it is excluded. If you have any financial assets, we have a separate standard called financial instruments, where there are 3 standards. Measurement and all, IND AS 109 talks about. Definition, IND AS 32, like this we have. So that standard talks about it, hence it is excluded. Similarly, if you have any deferred tax assets, DTA or DTL, which you use to account, we have IND AS 12, which talks about it, hence it is excluded from here. Just now we studied something, no? Biological assets measured at fair value less cost to sell. Even for those assets or employee benefit assets, don't worry about, don't apply these particular standard because respective standard gives a treatment for it. That is the reason. Since respective standard is recommending the treatment, this particular standard has excluded these assets from its scope. So how can employee benefits be assets, sir? We'll study in IND AS 19. Okay, there could be some assets relating to that as well. When I come to IND AS 19, I'll tell you. For now, let's not worry about that. Okay, so these are some of your exclusions. If you can remember it, or at least go through, just to be on the safer side, in case they decide to ask MCQ or whatever there. All right. First thing we already know, sir. Left, right, center, can you book, sir? Amortization, depreciation, you will start from the day asset is available for use. From the day asset is available for use, tangible asset you calculate depreciation, intangible assets you calculate amortization. From that day onwards, straight away can I start charging impairment loss also? Every year does the company go on booking impairment loss? No. Impairment loss will only come into picture if carrying amount, if it is greater than the recoverable amount. Carrying amount is the value of the asset that you are showing in your books. Recoverable amount, I had told you this, but just maybe we'll spend a detailed discussion we'll do it on recoverable amount, how to calculate that. Simply I had told you there are 2 ways to find out recoverable amount, either by selling the asset or by using the asset. Okay, there are 2 ways. Normally in the questions that we have done so far relating to impairment, recoverable amount, they had only given. Now we may have to compute this recoverable amount. Okay, we'll do a detailed discussion. So only if carrying amount, if it is greater than recoverable amount, then only there is a need to arise or need to account something known as impairment loss. Otherwise, this scenario will not come into picture. Okay, and what did I say for recoverable amount, sir? There are 2 ways to find it out, either by using it or by selling it. For selling means we'll use fair value. For using it, by using an asset, you will get some cash flow. No? You'll get some cash flow. That cash flow only becomes your recoverable amount. Higher of the 2, you just check whichever is higher, that higher amount becomes your recoverable amount. Okay, detail me, we'll still do it. Just now I told for the next pointer. Now, sir, recoverable amount, just now I told, either you can find out either by using it or by selling it. Selling means, okay, you will take the fair value. Using means you need to estimate the benefits the asset is going to give you. Correct? All right. So company means they'll have just one asset, sir. A big company means they'll have just one asset. Sir, and this standard is applicable both for tangible and intangible assets. Are they applicable? Do the company just have one asset or they'll have many assets? Many assets. Sir, if you go on asking the company to find out impairment loss, you have to find out recoverable amount. To find out impairment loss, you have to find out RA, recoverable amount. And companies will have thousands of assets. So do you think it is fair on the IND AS asking the company to find out RA on all the assets and every time? Because asset value also go on fluctuating. Fair value is true only particular date. No. Today, if you want to sell Infosys ka share, maybe the share price is 3,000. Tomorrow also it will be 3,000 or it could fluctuate. That means fair value is true only for a particular date. Today, if the fair value is 100 means tomorrow it could be same or it could be different. Yes or no? Correct? So in that case, how often should you find out recoverable amount? Every day, every month, every quarter, every year end, and that too for all the assets. Yes, no? It's a Herculean task, a big task. Yes or no? Hence they said, you do this impairment check, not impairment loss. You do this impairment check only if indicator of impairment is there. Only if impairment indication has come into your business, then only you do this impairment check. And to do this impairment check, what is the one thing you compulsorily need, sir? To do this impairment check, compulsorily you need recoverable amount. So indirectly I'm telling you, find out recoverable amount only if the impairment indicator has come. Left, right, center, every day, every month and all, you don't need to do this exercise. Find out recoverable amount only if the impairment indication exists. Okay, in layman terms, we can write here, find out RA only if what? Only if impairment indicator exists. Only if this has come, then find out RA. Otherwise, normally you don't have to find out RA at all. That is what second point is trying to say. Easy, everybody? Does that make sense? And more logical also, and kind of feasible for the company also. Now at least company will breathe a sigh of relief. Otherwise, no, instead of doing business, their main business will become finding out RA. Accountant though will quit left, right, center. Herculean task. Day in and day out is go on estimating, going to the data and figuring it out. Lot of problems. Yes or no? So that's the reason this particular leeway has been brought in. Okay. But whether impairment indication is there or not there, for 3 assets, compulsorily you need to do impairment check at least annually. For 3 assets, whether indicator is there or not there, every year at least annually. Yearly once at least you need to do the impairment check. 2 of it you already know. One is, you have studied this in your intangible assets standard itself. One is goodwill that you're arising as part of business combination. 2, intangible assets with infinite or unlimited useful life. And intangible assets not yet available for use. Remember we did intangible assets. Development phase expenditure of intangible assets. Can you capitalize, sir? Yes, provided what? TIFRC was satisfied? Yes. No? So intangible assets under development if you have. Is it already available for use? Is intangible assets under development already available for use, or it will be available for use later on? It is not yet available for use. It will become available for use later on. Yes or no? For such intangible assets, at least annually once you need to do the impairment check. Meaning you have to compare its carrying amount with recoverable amount and go on booking the impairment loss if it is there. Done now. This is the first in this paragraph summary. Okay. So what is it again? We will go a little slow and try to learn everything in the class itself. 1. Impairment loss ka accounting arises only if carrying amount exceeds or if it is greater than recoverable amount. Otherwise, no. And recoverable amount, you have to find it left, right, center every point of time? No. You find out recoverable amount only if impairment indicators have exist. Only if impairment indicator has come, find out RA and do the impairment check and see asset ka impairment loss is there or not there. However, even if impairment indicator is not there, for 3 assets, you have to do the impairment check at least annually. Those 3 assets are goodwill that you got as part of your amalgamation or business combination, intangible assets with unlimited or infinite useful life, and the third one is intangible assets which are not yet available for use. That is your intangible assets under development. So for these 3, do the impairment check at least once in a year. Meaning find out the RA, compare it with carrying amount to find out impairment loss. Okay. So for indefinite useful life, how to find out the value, sir? That is management ka headache, sir. You will get some benefits. Asset may have indefinite useful life. You take the benefits up till perpetuity. Actually, the standard says you have to take it restricted to 5 years. Next, we will see that how do you find out value in use. I will tell you. Okay, have to be a reasonable estimate on that. Okay, The main funda over here is, are you showing that asset's right value, recoverable amount? The moment you can conclude, if you have a reasonable estimate that what the recoverable amount is more than carrying amount, then it is fine. The main funda is that you should be able to recover more from that asset. That's all it is. Reasonable estimate. You don't have a concrete methods. You have to reasonably estimate. That we'll talk about it in a bit. Okay. All right. Great. Yeah. How to do recoverable amount for goodwill, sir? Yeah. I'll tell you about all that. You're again 3-4 steps. Probably this is tomorrow's session, and you're asking me to explain today only. Little difficult. Hang on. Okay. It'll come. Yes. I know that some assets don't give you direct benefits. What to do for them and all. Few steps ahead of me. I'll catch up with you. I told I'm a little slow. You have to give me some time. Okay, for now we'll learn this. We'll come to that. What to do for such assets. It is there. All whatever you're thinking, everything has been brought forward. Okay. Sir, we spoke something about impairment indicators, right? So what are those indicators? Could be one of the question running in your mind. Sir, impairment indicators, you can put them broadly into two categories. One is your external indicator. Another one is your internal indicators. External indicators means outside influence. One such is decline in the assets ka market value. You bought an asset, let's say for 10 lakh. Its value suddenly has become 4 lakh. That means market value has significantly reduced. Again, what is the word significant? It's a case-to-case based assessment, not defined. 10%, 20%, whatever, not defined. Case-to-case based assessment. So one such external source of indicator is decline in the asset ka market value. Okay. Two could be, you can take it as a technological factors. Now, due to chat GPT coming in, do you think all the softwares are relevant, or some softwares could go irrelevant, could become obsolete? Quite possible. So let's say one company has a software they purchased, but now chat GPT has come in, that software may have become obsolete. Correct. Quite possible. So this is what? Technological indicator or market indicator, you could say, or it could be a legal indicator. Like, let's say you have a liquor license. Government banned liquor in a particular state. I think currently also in the state of Gujarat and few other states, liquor is banned, if I'm not wrong. Okay. So you have a liquor license, but in that state, liquor only is banned. Do you think that liquor has any value? No. That license has any value? No. That could be your legal indicator as such. Okay. Like this. Or a few years back, government banned plastic. No. Let's say you have a know-how, how to produce good quality plastic. You have a know-how of it. You have some process you have developed. That is your intangible asset. Okay, but the government banned that level of micron plastic. That means, is that technology worth anything to you? No, it's become worthless because of the legal action. So these are all could be your external indicators, and also increase in the market rate. For now, just remember this. If this market rate is nothing but your discount factor. If discount factor increases, means your recoverable amount will reduce. Okay, I'll talk about this little later in one of the problems. For now, this is also if there is any increase in the market interest rate or a discount factor, that could also be taken as an impairment indicator. Just write this for now. When we do the problems, you'll understand this a little better. With numbers, you can understand. Okay. These are some of your external indicators. Decrease in assets ka market value, technological factors, legal factors, market factors, etc., or increase in the discount factor or market rate. They won't ask you direct question, just quickly brush them up in case they decide to ask in any sort of case study based or anything. These are all your external source. But there could also be an internal source. Internal source like, you give me some examples of internal source of impairment? Impairment means things are going smoothly or things are started to turn bad. Impairment means smooth flow, happy phase, or more like a sad phase scenario. It's more like a sad scenario, correct or no? So tell me, what are the internal indicators that can build up sad scenario, sir? One, if asset has got damaged. If there is any physical damage to the asset, that could be an impairment indicator. No? If the asset is working well, it may fetch a higher value. Suppose due to some reason that asset got damaged. How and all irrelevant. If there is a damage to asset, that could be our internal indicator. Okay. Or the company is suffering continuous losses. Company is making continuous losses. Okay. So how continuous losses will be an impairment indicator, sir? Sir, let's say company is producing 1 lakh units. They have a plant and machinery. They're using this plant and machinery to produce 1 lakh units. But they're making huge losses. So you know what company decided now? They're saying we're making too much losses. Let's take a step back. Let's produce only 70,000 units for this year. Okay, let's stabilize first. Okay, we're producing too much. We are not able to sell it. Hence, we are making huge losses. Let's only produce 70,000 units for 1 or 2 years and then see what happens. That means machinery earlier You from this machinery, how many units were you producing? 1 lakh. That means you are getting higher benefits. Now you are using this machinery to produce only 70,000 units. That means is the benefit same or less? Less. Correct. Now how do you find recoverable amount? Two ways I told. Either by using it, how much benefit you will get, or by selling it, how much benefit you get. If you are using less means due to loss, that means the benefit that you get from asset also will get reduced. So that could be an impairment indicator. Comfortable? Or change in the usage pattern of the asset. Change in the usage pattern of the asset. Let's say the machinery earlier was used as a double shift product. You used to use it in the morning also, you used to use it in the night also. Double shift production it was used. Same machinery, it had the capability. But now you have decided that you will use that machinery only as on a single shift basis. Only for one shift you will use it. That means there is a change in the way you are using that asset. This could also be, I'm not saying this will lead to impairment loss. I'm saying this could lead to impairment loss. These are all impairment indicators. Not necessary if this only should come. There could be others also. These are some just general factors that they are trying to bring in, which are all internal driven. Okay. So that's your internal and external driven indicators relating to impairment. Fair enough. Somebody is saying for other assets, it is not necessary to do annually. No, sir. Only for 3 assets, you do impairment check annually. That's what we discussed. Goodwill on business combination, intangible assets with unlimited useful life, intangible assets not yet available for use. Other assets, you'll do only if indicators have come. Okay, otherwise not required. Correct. All right. Any other doubts? Anybody so far that we have covered? This is again a practical standard. A lot of numerical questions are there, but we still do have some concepts. Let's cover them and take up the questions as well. So far good. Can I move forward? Okay. So we saw internal and external indicator. Going ahead. Recoverable amount. So the recoverable amount of an asset or CGU they have written over here. CGU means cash generating units. Don't worry about this for the time being. We'll probably, today we don't have time. Tomorrow we'll take care. I'll tell you what is CGU, what is its importance and all, etc. etc. For now, you just read the sentence as recoverable amount of an asset. Okay. We already know recoverable amount is what, sir? Higher of two things. One, either by using it or by selling it. When you sell, you will sell it at what value? Fair value. So recoverable amount is higher of fair value less cost to dispose or cost to sell. Or this is the amount you will get, benefit you will get by selling. No, there is another benefit which you will get from what? Using. That we call it as value in use. For our class purpose, we'll call it as value in use as VIU. Okay. So impairment recoverable amount is higher of two things. Fair value less cost to disposal. It's all given over here. Fair value less cost to disposal or value in use, whichever is higher. Find out two things. Whichever is higher, adopt that as a recoverable amount for your impairment loss calculation. This is your recoverable amount. Okay, first portion is by selling how much benefit you will get. Second portion relates to by using it how much benefit you will get. Each of it we will spend some time how to find out and all. It is there. For now, you have got the plain understanding what it is. Okay, if you have got it, question number 1, you will tell me. Okay. Carrying amount of the building in the books of Sun Limited is 300 lakh. Okay, carrying amount is 300 lakh it seems of a particular asset. As on the date, value in use is 250 lakh. Fair value less cost to sell is 238 lakh. Tell me what is the recoverable amount of this building? That's what they're asking you to calculate. What is recoverable amount? Recoverable amount is, first find out fair value less cost of disposal or cost to sell. How much is that cost of disposal? Fair value less cost of disposal is 238 lakh. Only this or one more? One more, which is what? Value in use. Have they given value in use? Yes, 250 lakh. What becomes your recoverable amount? Lower of the two or higher of the two? The higher of the two becomes your recoverable amount. So your recoverable amount is 250 lakhs. They only ask that. If you want, you can also find out impairment loss. Carrying amount of the building is 300 lakh. But recoverable amount is only 250 lakh. That means there is a difference. How much is that difference? 50 lakh. That 50 lakh will be accounted as an impairment loss. And think logically. Maximum, how much can you recover from this asset? Maximum that you can recover from this asset is either by using or by selling. Maximum you can recover 250. But you are showing that asset in your books at 300. Are you not overstating your assets? Maximum you can recover 250, but you are showing the asset at 300. So you are overstating the asset. So to bring back the position, we have a concept of impairment loss. Hence, the difference between the two is accounted as impairment loss. Question number 1 over G. Move on, G. Okay, next concept. Circumstance in which it is not necessary to calculate both fair value less cost to disposal and value in use. They are telling under which circumstance. So recoverable amount is higher of these two. Fair value less cost to disposal and value in use. Whichever is higher, that becomes recoverable amount. They are telling on which circumstance you don't have to find out both. Meaning indirectly they tell find one that is good enough. Okay, understood the scenario? You tell me which scenario. Actually, you know this is common sense. Actually, it was not even required, but still they brought it. Under which scenario both you need not estimate. Don't go through the book. Think and tell me. Both need not be estimate. One, if you estimate, that is good enough. Which scenario is that? One at least you can easily tell me. Somebody is saying when fair value is not available. Okay. No, that is okay. Other than that, you tell me. Customized research. No, you are overthinking. Actually, it's just simple mathematics. So carrying amount is 300 lakhs. Carrying amount is 300 lakh. Let's say you found out value in use. That is 400 lakhs. Carrying value in use is how much, sir? 400 lakhs. Now you tell me, is there any necessary for me to find out fair value less cost to disposal? Absolutely no. Why? Sir, I know that if value in use is 400 lakh means, is the asset impaired or no impairment loss? No impairment loss. This fair value could be 0. Even if this fair value is 0, what will be your recoverable amount? Recoverable amount is higher of the two. So that means recoverable amount will be 400 lakhs. So that means will there be any impairment loss or no impairment loss? So that is what they tell. If any of these factors, if it is greater than carrying amount, then there is no need to find out the other element because we know that there is no impairment loss in that particular case. That is what they have written here. Did we understand? And the second case is the one that you told. If you are not able to find out the fair value, because some assets, if you remember, intangible assets. If for intangible assets also, either you can go for cost model or revaluation model, I told you. But in case if there is no active market for certain intangible assets, if it is relating only exclusively to the organization, and if you don't have active market for it, then such intangible assets, we should only go for cost model is what I had told you in IND AS 38, if you remember. That is what they're telling over here. If an asset does not have active market, that means can you find out fair value? See, fair value is driven from the market. So if the asset itself does not have market, that means what you'll do? Can you find out fair value? No. That means in that case, value in use itself becomes, find out value in use. That itself becomes what? Recoverable. That is the second case. In that case, fair value need not be estimated. Correct. These are the two cases in which both of the components you need not find out. Understood that? Need some time? Or got it? Online people are telling when will you wind up the class, sir? Yeah, another half an hour to go. Wait, chill, Marty. They're not telling, I am just telling. They are brilliant students, full they're listening. Very nice people. Okay, awesome. All right, next one. Okay. Hectic season going on in office, huh? Those of you who are going for articleship, July month. So a lot of individual filings, huh? Lot of individual filings going on. You're working, you're slogging, or still chill only in office, huh? Yes, sir. Hectic, sir. Principal is not even giving extra fees, sir. Same stipend, but he's asking us to work extra. Correct, no? Okay, at least you must be getting that nice meals and all, no? At least that's what used to happen in our office. Whenever the tax audit season used to come, or even for that individual filing, we used to stay late, but at least we used to get some nice meals. I'm talking about 13, 14. I completed my articleship, I think, in 2011. No, I think probably 2011. So that long time ago. That time, at least they used to bring a lot of samosas, this, so that, too. Nice chats they used to get. At least we used to slog on that. At least that is coming into the office, I think. Okay, but that is also nice in a way, because a lot of people are assembling. Normally, what happens in RCA firm, most of them go for individual audits. You'll not meet your friends at all. But tax audit or this filing season is a time where all of you actually come to office, work together, you're slogging a little bit, at least you'll get to know each other better, and kind of it improves the bond as well, which is required in our fraternity. That is one thing I find in CA fraternity to be lacking. Generally, if you just check MBA, especially the MBA grads who are from the top tier colleges, IIMs, BITS, Bilani, and these people, they have a strong network, sir. They keep in touch with each other. Because I have my cousin who is from one of those Ivy League colleges. Okay. Oh, he is almost in touch with his senior, 1 or 2 years seniors, 1 or 2 years juniors, along with his batchmates. Each of them know where they are placed. Continuously they talk. They're saying this company, in our company, this is opening is there, that is opening is there. They hire the people from their own batch. So like they have a close network. Even the funding, ending, when they start up, okay, each of them help out each other. Obviously there is competition, but still the network is pretty strong. But in CA, I don't find that. You'll always be like, my exam, my certificate, my work. So whenever somebody is coming for practice, especially this happened to me truly. I came into the teaching field because I was a failure at practice. I tried for 6 months. I didn't have a backing. I went left, right, center to many meetings and all. It didn't work out for me. So I tried teaching as a like to kind of pet bharne ke liye type. So I had to earn some money, So I came into teaching because there was no backing. Each people are more like selfish. If I give away my client, then what will I do? That kind of attitude. We don't have that strong network. We should kind of incorporate that, because only then the fraternity will improve, and when fraternity improves, all the members in it also will get benefit from it. So we need to kind of broaden our horizon. Okay. In KPMG, May, June, still July 15, very busy, sir. Okay, now it's starting, sir, of new audit company, so we'll get busy. No problem. Enjoy. Okay. All right. Coming back, drilling over. Now, can we come back to the topic? Fair value less cost to cost of disposal. So what do you mean by fair value? Actually, see if you can remember this definition. This definition of fair value, we have another standard called IND 113, which talks about fair value measurement. How you find out fair value? The whole standard is there, because many standards use this fair value for their recognition. Hence, they brought in, created a whole new IND called IND 113 for fair value measurement itself. If you can remember this definition, it will be nice according to me. Easy only. Fair value is the price paid to sell an asset or to transfer a liability. Fair value is the price received when you sell an asset or price paid when you to transfer a liability in an orderly transaction between market participants on a measurement date. That's all. Only few keywords. Fair value is the price that you receive when you sell an asset or transfer a liability in an orderly transaction between market participants on a measurement date. 5 key metrics. Okay. So what is this? So obviously, sir, should you find out fair value only for assets or also for liability? Liability also. In this standard, our scope of fair value is restricted only to the assets. That does not mean liabilities don't have fair value. Even liabilities can have fair value. Yes or no? So liability is something, the amount that you receive when you sell an asset or amount you will pay when you transfer or pay off a liability in an orderly transaction. Orderly transaction means what? I should not put a gun to your head and say, sell me for 100 rupees. Is that an orderly transaction? No. Orderly transaction means there should be a proper exchange, proper process to it. Like a stock exchange. You buy the share, somebody sells the share. Is there any force? There could be an emotional force. You're facing huge losses, or you are in the, you want to make huge profit. In that compulsion, you may buy. But is somebody forcing you to sell? Is your broker, government, or anybody forcing you to sell? No. That is happening as a natural process. No. That's what we mean by orderly transaction. It should not be a forceful one. Orderly transaction. Between whom? This buying and selling will happen between whom? The buyer and seller. Yes or no? That buyer and seller, we call it as market participants. Obviously, in each market, there will be a buyer as well as a corresponding seller. So that's what this buying, this transfer and all should happen between a market participants. Okay. And on a measurement date. So fair value is like balance sheet. If you prepare balance sheet today, it is valid only for today. Tomorrow, if you prepare the same balance sheet, will the asset and liability ka value be same or it will change? Change. Same goes for fair value also. If you prepare fair value, that fair value is true only for today. Tomorrow, the fair value could be different. Hence, fair value is always found out on a particular date. That we call it as measurement date. Easy, everyone. Can we repeat it once more? See if you can remember it. Fair value is the price received when you sell an asset or transfer a liability in an orderly transaction between whom? Market participants on a particular measurement date. This definition is given in IND AS 113. Okay, awesome. Sir, for ITR, what is ITY? For ITY, book value is fair value. For liability, okay. For liability, book value could be fair, could be. Not necessarily for everything, we'll learn. But generally, yes. Generally. Okay, because even liabilities, no, so far your scope of liability is restricted to creditors, so bills payable, etc., etc. There is one whole standard called financial instruments. There you will come across something known as financial liability, where you will see there are a lot of dramas behind that also. We'll study. Okay, big ticket standard little later. Not necessarily so. Your statement is true, not necessarily for everything. There are more which we will learn along the way. All right. So, excuse me. So these recoverable amount is nothing but what, sir? Is it fair value or fair value less cost to sell? Fair value less cost to sell. Cost to sell you already know of it, no? Same thing, brokerage, etc., etc. if it is there. But do not include finance cost and income tax expense. You know? They are not part of your selling expense. No? Is income tax related to your selling expense, sir? No. Same goes for your interest cost also. Transfer those off and all. Finance cost and all goes off to SPL. Don't bring it in here. Okay. Now, there is a preference that is given to fair value because you could have multiple ways of fair values to find out fair values. So, the first preference you will give for fair value here is binding sale agreement. Meaning, let us say I have a particular patent. Currently, I'm showing it in my books at whatever value. But I have entered into an agreement with another third party. I have a patent and I have entered into an agreement with another third party. Let's say I am A Limited. I've entered into an agreement with X Limited to sell this patent. I made a binding sale agreement, meaning he has also signed, I also signed, maybe the agreement is registered, whatnot. Okay. And I've agreed to sell this patent for 50 lakh rupees to him. Okay. There's an agreement between A and X. That A will sell this patent to X Limited at 50 lakh. Now tell me, to find out the fair value of this patent, should I have to go to any market? Should I have to go to any market and find out its fair value, or this only is fair value? This itself becomes fair value because you have entered into a binding sale agreement. So first preference will always be given to binding sale agreement if you have any. Correct? No, because many assets will you sell it, sir? You will sell the assets only under rare circumstance. Yes, no? If at all you have binding sale agreement, that you take it as a first priority or first preference. If you don't have it, what is the next best priority according to you? Go to the active market. Active market means is a market where there is a large number of buyers and sellers. Like stock market, if you want to find out the fair value of a particular share, the best way to figure out that is what? Look at its price in Bombay Stock Exchange or National Stock Exchange where there are a large number of buyers and sellers. That becomes the active market. Okay. If you want to sell, let's say furniture, if you want to sell, then you can go for OLX or Snapdeal or whatever it is, like these. Go there, go to pick a value from that market where there is a large number of buyers and sellers. That becomes your second priority. Easy. First priority to sale agreement, binding sale agreement. Second priority to the active market. Active market means where there exists a large number of buyers and sellers. Third preference you give it to the, if you say this also is not there, active market is also not there. That means whose asset is it? Management. Management best estimate you can do. You can find out the fair value by management itself can find out the fair value using their best estimates. Like let's say your asset may not have fair value, but your competitor asset may have a fair value. Find out that if you have that data, if you have any other competitor, if he has any similar asset, and if that similar has a fair value, that you can adopt as your asset ka fair value, like that. That is your best information, management best information. Third priority. If you are saying no, that is also not possible, then to hell with you. Forget fair value. Value in use becomes what? Recoverable. Meaning ignore fair value. That is the last option. Because we gave multiple options. Everything you're saying no means what? Ignore fair value. Find out value in use and that itself becomes recoverable. Fair value you need not find it. These are your preference order. Confusion? Got it. People, move on. Okay, so we currently saw about fair value. Next, we'll go for value in use. For our class purpose, we'll call it as VIU. Value in use. So value in use means what? In layman terms, value in use means by using the asset, how much cash flow are you able to generate? If you have, let's say, a plant and machinery, obviously you will use it. By using it, you will get some cash flow. That becomes your value in use. Okay. But the problem is, let us say let's say I have a plant and machinery. The carrying amount of the asset is, let's say, 10 lakh rupees. Carrying amount of that particular plant and machinery is 10 lakh rupees. Now I'm finding out VIU. VIU means I have to estimate how much benefits or how much cash flow I will get from this plant and machinery. Okay. Let's say I found out that I will get the cash flow for, let's say, 4 years from that machinery. Okay. First year, let's say 5 lakh, and then 6 lakh, then 7 lakh, and then 8 lakh. Done. This is the cash flow I'm expecting to get from this particular asset called plant and machinery. Okay, what is the total of this? 11, 18, so 26 lakh, correct? No? Let's say fair value I'm not able to find out due to whatever reason. Fair value I'm not able to find out due to whatever reason. Can I take 26 lakh as the recoverable amount? You got my question? I found out the cash flow that I will get from this machinery. I feel management feels they'll get it for 4 years. This is the cash flow expected. The total of this cash flow is 26 lakh. Can I take 26 lakh as the recoverable amount, compare it with the carrying amount, and then conclude impairment losses there or not? Can I take this as RA? No. Why? Why can't I take this 26 lakh as RA, sir? Fair value. I told you, fair value you cannot find out due to some reasons. If you are not able, we have already learned, no? If you are not able to find out fair value, then value in use itself, you can take it as recoverable amount. That gully we have already established. So in this case, let's assume fair value you cannot find out. Okay. Now tell, can I take 26 lakh? Absolutely no. Why? Sir, this 26 lakh, is it the present value or is it the future value? Future value, correct? Now this 26 lakh benefit I may get, but I will get it immediately or over a period of 4 years. Over a period of 4 years, correct? But this 10 lakh rupees, is it future value or it's present value? The current carrying amount of the asset is 10 lakh. Can you compare present value component with a future value component and say there is asset is impaired, sir? That is wrong, no? If you want to compare, means both of them have to be on the same platform. Since carrying amount is on which platform? Present value platform. So you have to get this cash flow also to what platform? Present value platform. So this is your cash flows. That means this is your future cash flows. To find out present value, we have to multiply discount factor. Okay, everybody. Okay, so they will give you a discount factor in the question. Let's say discount factor is 10%. I'll not calculate. Then you will get what? Present value of cash flows. Okay, no? Let's say present value of cash flow is, let's say 12 lakh rupees. Present value of cash flow is 12 lakh rupees. Now this 12 lakh only becomes what? Value in use. Because this 1 lakh is the present value of cash flow. And this carrying amount is also present value of cash flow. If you are not able to find out the fair value, then value in use itself becomes recoverable amount in that case. Comfortable, everyone? So that is what they have said over here. Value in use means not total benefits. It is the present value of the cash flow that you are planning to get it from the asset or CGO. Don't worry about CGO word for the time being. Stick only to the asset. Understood that meaning? That's the component. Okay, everyone. You remember I had given one external indicator. I told you we'll discuss later. What is that? Increase in the discount factor. If discount factor increases, no sir. If you increase, so let's say you found out you took 10% as a discount factor. Your present value, how much are you getting? Present value at 10% discount factor, you're getting it as 12 lakh. Go home and do this exercise if you want. Let's say present value, you take it as 15%. Actually, I have not calculated this. I've just assumed. Okay. You take two discount factor as a homework. You know how to find out discount factor and all? No? Everyone you have done in FM? Okay. Go home and do it. Find out the present value of the same numbers. At 10% discount factor, you find out. 15% discount factor, you find out. If 10% discount factor is 12%, 12 lakh means at 15%, it will not be 12 lakh. It will be lesser. Maybe it could be 9 lakh, 10 lakh, whatever. But definitely it will be lesser than 12. Okay. So that means this only becomes your value in use. No? Present value of cash flow itself is value in use. So if value in use is a benefit, if this benefit is reducing means, is it a good sign or a sad sign? This value in use, if it is reducing means it is a sad sign. Yes or no? That is what we said. If there is any increase in the discount factor in the market, that is also a impairment indicator. Because if this discount factor increases means your present value of benefits will reduce. Therefore, your value in use also will reduce. Therefore, your recoverable amount also will reduce. So there is a chance that carrying amount could be more than the recoverable amount. Rather, you might get some impairment loss. Hence, discount factor ka increase is also an impairment, external impairment indicator. Got it now? You can go home and test it out if you want. I've just assumed this. Okay. Take any two random two discount factors, any cash flow you take. The one with a lower discount factor will give you a higher final number. Like that. You have also done in FM, but nonetheless, if you want to still prove it, you can prove it. Go home and do it for your exercise. Now I'll not bother about that. Okay. So that is your external indicator. This portion is clear for everybody. Can I move forward? Yes. Okay. Sir, you are finding out value in use means you have to estimate the cash flows, because that's one of the basis for VIU. So when you are estimating the cash flows, they are brought in few parameters. What parameters is? If you want, you can just write this down. I don't know whether it's called out. No, actually, it's given there. Okay. So when you are estimating the cash flow, few things you exclude. Few cash flows you exclude. One is, if there is any future restructuring that you're planning to do, which the entity is not yet committed. Future cash outflows or related cash savings or benefits that are expected to arise from future restructuring, which is not yet committed. So this actually I've studied. If you remember, CA Inter, there was accounting standard 29. For restructuring cost, you made a provision. The word this restructuring has come in AS 29. If you remember AS 29, you would have known this. AS 29 clearly said for restructuring cost, you need to make some provision, provided there are some conditions. Okay, let's not go there. No problem. I don't know how much of it you remember. Nonetheless, so we have anyway, for provision, we have a separate. There you had AS 29, no? Here we have IND AS 37. We'll study all that. But just thought the word came, so I thought, if you remember, I can connect to the dots. If you're not remembering, absolutely no issues. Let's stick to this. What do they mean by this is, let's say, sir, there is an airline, whatever, Indigo or whatever airlines. Okay. You remember the aircraft, no? Let's say aircraft on, obviously it has two sides. One is your walking aisle. On the each side of the walking aisle, you'll have seats. There are 3 seats this side. There are 3 seats that side. Okay. Currently. But Indigo Airlines, you know what they want to do? They want to make it 4. From a 3-seater, they want to go to a 4-seater on each, or maybe 4:3 or 4:4, whatever. This is what they want to do. Restructuring means changing the way currently the organization is happening. Change in the management structure. Okay, change in the top management, discontinuing a particular product. All these are, we call it as restructuring. Change in your operation. Currently, Indigo Airlines has this particular setup, 3:3 wala setup, seating setup. Now they want to go for 4:4 setup. Okay, so these we call it as what, sir? Restructuring. Sir, can you do all this restructuring free of cost, or there will be some cost associated with it? If you do this, you have to change the whole airline structure, no? From 3 tests to accommodate 4 now. Okay, that means this restructuring will have some cost also, and it will also have some benefit also. Because currently, on each line, you can accommodate only 6 passengers. After restructuring, on each line, you can accommodate now 8 passengers. That means you will be able to sell more tickets, more revenue. Yes or no? So that means this and all will have some cost as well as it will have some benefits. But this is Indigo Airlines ka plan. They have planned. That means they have committed to it or not yet committed. Committed or uncommitted. Uncommitted or not yet committed. Yes or no? So this cost and this benefit, don't bring it to your cash flow estimate is what they are telling. Okay, now, because when you do this restructuring, there will be a cost also, there will be some benefit also. And moreover, this company is committed or uncommitted? Uncommitted to it. So when can you say it is committed? Let's say Indigo Airlines started implementing this plan. Indigo Airlines started implementing this plan. Now they are uncommitted or committed? Committed. Okay, so if they have either implemented the plan or they have communicated the plan, either if they have implement, this we'll study in IND AS 37 also, to say that you're committed, either you check for the implementation or you check for the communication. Let's say Indigo Airlines also want to fire some employees. They feel our existing employees ka age group is slightly on the higher side. Now they're not able to offer that good a service. We'll hire more young blood, more youngsters we will hire. So let's say they want to fire, let's say 500 people. Air hostess, 500 air hostess they want to fire. Okay. So can you send all this air hostess and all at free of cost, or you have to pay them some money and then send? You have to pay them some compensation and send. No? We call it a severance pay. Yes. So you have to pay them and then send. So that means this is also part of your restructuring. Now, Indigo Airlines has written a mail to those employees. Boss, you will be fired. Not now, you will be fired within a month's time. Tell me, uncommitted or committed? Indigo Airlines ka management wrote a mail to those employees. You will be fired by the month's time. In 1 month's time, we'll fire you. So, uncommitted or committed? Committed, because the plan has been clearly communicated to them. Okay, or you should have started firing the employees. That should have happened. That's what we mean by that. So, if you have any uncommitted restructuring activities, that cost as well as its benefit, both you ignore for your cash flow computation. They will give you this in the problem. Okay, basically restructuring activities you ignore. That is first funda. Any confusion, sir? If committed, you can include. Yeah, committed you can include, uncommitted leave it. All right. Then cash flows that are expected to arise from improving or enhancing the asset performance. Now take this example only. Earlier the airline had only 3. Now how many seats it has? 4. That means you will get some benefit. Okay. So obviously more number of passengers, if you are able to accommodate, means you will get more revenue. If you are improving the assets, some part you replace, you're planning to replace the parts or anything, that means that asset will start giving you more benefits now. Can we include this more benefits to our cash flow estimate? That will be wrong. Why? That will be wrong. Why? Does a carrying amount include that? Does a carrying amount include those benefits or those costs? No. Carrying amount is as on a present condition. Yes or no? That means the cash flow that you get from that asset also should be related to the present condition. So any future improvements if you are planning to do on that asset, okay, and if you are planning to receive some benefit out of it, exclude it. Because asset ka carrying amount does not include that cost currently. Because you have already done this in India 16. If you are replacing any new parts, means new part ka carrying amount you will add. Old part ka carrying amount you will de-recognize. That replacement part accounting you have to do, we have studied. Yes or no? So does the carrying amount has this feature already? No. Carrying amount is worked out by keeping what? 3-seat information or 4-seat information? Only 3-seat information. So that means the benefit that you get also should be parallelly. Only then comparison will be correct. Yes or no? If you compare one carrying amount on a 3-seater level, benefit on a 4-seater level, it will be comparing oranges with apple with oranges comparison. That will be wrong. Yes or no? Hence they are saying if you are planning to do any improvements to the asset, obviously you will get some future extra benefit. That benefit, if it is given in the problem, exclude it. Do not consider, because your carrying amount excludes that. That is the reason your value and use also should exclude it. Otherwise comparison will go for a toss. That's the reason. Understood? Any doubt? Or next one. Okay. Third one is income tax receipts and payment. If you paid any income tax, or if you have received any income tax refund for that matter, ignore it. Because tell me, sir, income tax, is it related to any asset, sir? No, income tax is more towards the general in nature, no? Okay, so it's a general nature, ignore it. And the discount factor also, they say, the discount factor that you use, no, should be a pre-tax rate is what they say. The discount factor that you use is always pre-tax. Hence, income tax receipts and all you should ignore. Because more or less it is general in nature, not related to any specific asset. That is the reason. It's general, so ignore. These are your exclusion perspective. Okay, people? Okay, I think if you want, you can write some more pointer. It may be relevant for the problems. If you have a notebook, you can just write. I think it is there in study material. Maybe I'll just bring it in. Sir, one of the justification, I'll simply make a note of it. Remember it, it's okay. The cash flows, no? Obviously, to find out value and use, you are estimating the cash flow. They are saying restrict your cash flow only to 5 years. Consider the cash flows only to the extent of how many years, sir? 5 years. Meaning, if you have any asset, you will get benefit from that asset. You will get cash flow from that asset. Take the cash flow only to the extent of 5 years unless higher period is justifiable. Take more than 5 years only if justifiable. Otherwise, as a thumb rule, restrict your cash flow only to 5 years. Okay? This is one other thumb rule. Okay? And Another one is, you give more weightage to higher weightage or more weightage to the external evidence. You give more weightage to the external evidence. Meaning, let's say management feels, they will get the benefit from the asset to the extent of 1 lakh. They feel the benefit that they'll get from the asset is 1 lakh. But industry trend says, this is management driven. Management feels they will get a benefit of 1 lakh. But the industry trend says you can get the benefit only to the extent of 70,000. That is what industry is saying. For your impairment calculation, will you take 1 lakh or 70,000? You will give more weightage to the external evidence. Because impairment, nobody wants to impair the asset, no? Especially management. It's a kind of a black mark, yes or no? Science, they've said, give better weightage or higher weightage to the external evidence. If external evidence says the benefit is only 70, take 70 only and work it out. These are all practical driven. How it can vary, it's very debatable. Okay, but if in the problem, they will be given to you. About like this, they'll give. If they give, place higher weightage to the external evidence itself. I think that should be good. Okay. So far now I think we have a fair idea about what it is. Yes. So let's we'll do one or two problems, then quickly have a recap maybe. Okay, check this. Saturn India Limited is reviewing one of its business segments for impairment. The carrying amount of the asset is how much? They've given net assets. Don't worry about this now. You think of it as asset only, because there is also not only asset, we also do impairment check on a CGU level, cash generating units. I've not yet explained that. So do not worry about that. So what is the carrying amount of that asset, sir? 40 million. Management has produced two computations of value in use. The first value is 36 million, excluding the benefit to be derived from future reorganization. Okay. So includes or excludes? Excluding future reorganization, fair value is 36 million. Second value is 44 million, but it includes the benefits derived from future reorganization. So future reorganization is your future improvements. Future improvements ka benefits, should you include it or exclude it? Just now we learned in game. Future improvement benefits we should consider or exclude. Exclude. That means what will you take as value in use? What will you take as value in use? 36 million or 44 million? 36 million you will take it as value in use. Because 36 million includes or excludes that? Excludes that. And it should be excluded. Yes or no? That becomes your value in use. Comfortable, sir? There is no... Yes, online also good with this? They're talking from the asset perspective over here. They're not talking about general reorganization. Okay, they're talking more from the improvement side of things here. Okay, that's what they mean by benefits derived from future reorganization. Even if they don't give, assume it. If you're thinking on those lines, committed or uncommitted, take it as uncommitted only, still there. Okay, but here what is the intention of this question is, future improvement benefits will you consider or not? Because this is related to a specific asset. Future improvement benefits related from that asset should not be included. That ground the answer is built. Okay, so value in use is 36 million. And they are saying there is no active market for this asset. If there is no active market means, can you find out fair value? If there is no active market means you cannot find out fair value. That means value in use itself becomes what? Recoverable amount. So both are same, correct? So do you know the carrying amount? Yes, the carrying amount of the asset they only gave, which is how much? 40 million. Is carrying amount greater than recoverable amount? Yes, by how much? Carrying amount is greater than recoverable amount by 4 million. That means indirectly what they're saying, impairment loss is 4 million that you book. In this case, that's all. Excuse me. This question is over. Yes? All right. Let's maybe, 1 minute. Sure. Maybe question number 4 we will do and maybe wind up in the interest of time. Question number 4, sir. A leading manufacturer of steel having a furnace carried in the balance sheet at 250 lakh. So that means what is the carrying amount of that asset, sir? 250 lakhs. It's carried in the balance sheet means showing in your books at 250. As at that day, value in use and fair value is 200 lakh. Both value in use and fair value is? Carrying amount is 250 lakhs. Next, we need to find out recoverable amount. For recoverable amount, we have value in use and fair value or fair value less cost of disposal. You have to take fair value less cost of disposal. Correct now? How much is value in use? They told value in use and fair value is 200 lakh. So value in use is 200 lakh. Fair value is 200 lakh. Should we take fair value or fair value less cost to dispose? Fair value less cost to disposal. And what is that cost of disposal? 13 lakh. So fair value less cost of disposal is 13. So that means this becomes 187 lakh. So what will be your recoverable amount? The recoverable amount is higher of the two. Is higher of 200 lakh and 187 lakh, which is what? 200 lakh is your recoverable amount. This is 250 lakh only. So that means, do you have any impairment loss in this particular scenario? Carrying amount is 250 lakh. Recoverable amount is 200 lakh. So is carrying amount greater than recoverable amount? Yes. By how much? 50 lakh. So that means the impairment loss that you account here is 50 lakh rupees. Okay. That's your problem. Done. I think next problem is relating to a particular concept. Don't think we have time for it. So it's already time up. So let's wind up for today. Let's continue the session in the tomorrow session, same time. Okay. Thank you guys. Bye bye.